Dollar reserve currency status endgame. How the dollar may lose its reserve currency status. And this is really going to blow your mind. So you got to sit down and buckle up for this one. I'm going to explain this to you in 3 simple, fast steps. Step number 1, we need to understand how dollar swap lines actually work. A few different players we're going to use for this example. And to be clear, the Fed has swap lines opened up with several different central banks. But for this particular example, we'll of course use the Fed and the BOJ, the Bank of Japan. Under the BOJ, we've got a Japanese bank and a Japanese corporation. Now, to find out the details of exactly how this works, let's go straight to the Fed's website. In general, these swap lines have 2 transactions. When the foreign central bank draws on its swap line with the Federal Reserve, the foreign central bank sells a specified amount of its currency to the Federal Reserve in exchange for dollars at the prevailing market exchange rate. The Federal Reserve holds the foreign currency in an account for the central bank. The dollars that the Federal Reserve provides are deposited in an account that the foreign central bank maintains at the Federal Reserve Bank of New York. At the same time, the Federal Reserve and the foreign central bank enter into a binding agreement for a second transaction that obligates the foreign central bank to buy back its currency on a specified future date at the same exchange rate. So a little bit like a repo transaction. The second transaction unwinds the first. At the conclusion of the second transaction, the foreign central bank pays interest at a market-based rate to the Federal Reserve. Dollar liquidity swaps have maturities ranging from overnight to 3 months. Now, this next part is very important. When the foreign central bank loans the dollars it obtains by drawing on its swap lines to institutions in its jurisdiction, the dollars are transferred from the foreign central bank's account held at the Federal Reserve to the account of the bank that the borrowing institution uses to clear its dollar transactions. Now, if that doesn't make sense, I'll explain it in just a moment on the whiteboard. The foreign central bank remains obligated to return the dollars to the Fed under the terms of the agreement, and the Federal Reserve is not the counterparty to the loan extended by the foreign central bank. The foreign central bank bears all the credit risk associated with the loans. Now let's get a visual of exactly what the Federal Reserve was saying on their website. Again, we've got the Fed and the BOJ. These transactions can go overnight or 3 months, but my guess is they could continually roll them over. So we'll start with the Fed's balance sheet, the asset side and the liabilities. Assets, as you guys know, typically treasuries, mortgage-backed securities, or mortgage-backed sausages, and more treasuries. We've got bank reserves. And on the BOJ side, we have JGBs, Japanese government bonds, and their bank reserves denominated in yen, a currency they can print. So the BOJ goes to the Fed, says, Fed, we need a swap line. And they say, okay, no problem. So what happens on the Fed's balance sheet is they create bank reserves for the BOJ. And this is an account that the BOJ has with the Fed. So it creates dollar reserves, just like it would for a primary dealer bank. And then the BOJ creates another swap line for the Fed denominated in yen in the same exact process. So the Fed's balance sheet now on the liability side has dollars for the BOJ. And on the asset side, it has yen that the BOJ printed for the Fed. On the BOJ's balance sheet, the Fed has a yen swap line as a liability. Again, those are just yen they printed up for the Fed to match up with the swap line over here. And on the asset side, they have the swap line the Fed created for them denominated in dollars. Now let's assume we have a Japanese corporation that really needs dollars. It's got a ton of dollar-denominated debt and the cash flows are down, so it doesn't have the dollars coming in that it needs to satisfy the debt. So it goes to the Japanese bank, says, listen, I need a dollar loan because I've got creditors I have to pay. But the Japanese bank says, listen, we really don't have the balance sheet capacity to create more dollars. This goes back to the euro-dollar system that, as Jeff Snyder has pointed out many times, is broken. More on that in just a moment. So the Japanese bank doesn't have the balance sheet capacity to extend any more dollar-denominated loans because they don't have the dollar reserves to back up the loans. So the Japanese bank says to the BOJ, listen, we need to access that swap line ASAP. So they say, okay, fine. So they go over to the Fed. Let's say $1 million, just to make it even math, goes from the swap line over to the Japanese bank. So they put that onto their balance sheet. It becomes a dollar reserve asset. So on the asset side, it would be the dollar reserves, the $1 million they just took from the swap line. That creates more equity as a liability. But the key here is they extend a loan to the Japanese corporation. So how the balance sheets look after the Japanese bank extends the loan is now the Japanese bank has an additional loan and they have an additional deposit for Japanese corporation. We'll assume the Japanese corporation has an account with the same bank. So then the corporation's balance sheet now has additional deposits as an asset, but it has additional dollar-denominated loans. So you can see how it's kind of temporary. Yes, it gives them a little cash flow they need to service their debt, but now they're in a deeper hole. So let's go back to the euro-dollar system, because those of you people who have watched my videos are probably scratching your head right now and saying, well, George, I thought all these banks outside of the United States could just create funny money out of thin air. I thought they didn't have reserve requirements, so what's holding them back from creating more dollar-denominated loans? To understand how all the pieces of the puzzle fit together, let's move over to the other side of the dry erase board and look at an example of how money is created, how loans come into existence. We'll start with Bank A and Bank B. On Bank A's balance sheet, there are reserves and deposit. We'll call it $100. So the reserves are assets, the deposits, the customers' checking accounts are liabilities. Bank A's first step is creating a loan for, let's say, another $100. So there's a loan and new deposits. This is funny money that was just created out of thin air. It didn't exist before. So now in the system, there's $200 instead of $100. Let's also assume the customer that took out the loan has a different bank, Bank B. So Bank A would transfer the deposits for the customer over to their account. Now it's a liability on this side, but the reserves would have to follow the deposits to back them up. And it's 100%. A lot of people get kind of confused and they think, well, if there's a 10% reserve requirement, then maybe only 10% of the reserves would go over. But that's not how it works. So just to restate this so everyone's on the same page, if there's a $100 deposit that is transferred over to Bank B, there's $100 in reserves that would also have to go over to Bank B. Step 2 is Bank B creates an additional loan for $100, let's say. So now their balance sheet has the reserves, the deposits, an additional loan for $100, and an additional deposit. Well, let's say this customer banks with A, so they'd have to do the same thing. The newly created deposits would have to go over to the balance sheet of Bank A, in addition to the reserves that were just transferred to Bank B from Bank A. So those $100 in reserves would go back to the balance sheet of Bank A. So let's look at how the balance sheets look now. For Bank A, on the asset side, they have the loan that was created here and the reserves that were just transferred from Bank B. The original $100 in reserves they started with. On the liability side, they now have a $100 deposit, another $100 deposit, and on Bank B's balance sheet, they have the $100 loan that was created and the $100 deposit they got from Bank A up in this step. So the entire banking system now has the original $100 in reserves, but it has $300 in deposits. So what happens if all of the loans are paid off with the deposits that now exist? Well, the money supply would automatically shrink from $300 back to $100. But there's another step. So we went from 300 to 100, but if we started with 300 euros in addition to $300, and we go down to $100, but there's still 300 euros in the system, it's supply and demand. What would happen to the value of the dollar relative to the euro? It would appreciate. And the opposite would happen. If we created more money in the system, let's say we went from 300 to 600, but then there were only 300 euros, the value of the dollar most likely would depreciate. Another thing I'd like to point out is one of the main drivers to this system continually creating more and more dollars or currency units is they have to have productive lending. There needs to be a business out there that can take the loan and create more and more goods and services. That is key. If there's only consumers out there wanting to take these loans, there's no way they're going to do them because at a certain point, there's not enough income coming in to service the debt. So they have to find productive ways to lend or the system stops functioning. Another way to look at it is there needs to be more and more economic output, and taking it down to its very simplest terms, there needs to be more and more cash flow. Step number 2. This is how swap lines probably won't even work. Remember, the Fed creates these bank reserves that are the dollar swap line for the Bank of Japan. Those dollar swap lines can be accessed by the Japanese bank. But remember, it all goes back to cash flow, economic output, and productive lending. But let's think about this. Let's say the Japanese corporation took out all this USD debt during ZIRP. We'll call it back in 2012, 2013. So if the interest rate is almost zero, that means the hurdle rate is what they call it. So that means how high of a bar or how much profit, how much cash flow does the corporation or business or person have to have coming in order for the bank to create the loan. The lower the interest rate goes, the lower the hurdle rate, meaning the less qualified the borrower has to be. So this company is one of these zombie corporations. The bank who issued them the loan initially didn't lend productively like we were talking about in step number 1. So this is lower economic output. Again, it goes back to the Federal Reserve creating all of this malinvestment with unintended consequences. And of course, now we have the cerveza sickness, meaning the amount of global economic output is decreasing even further, and we have a narrative politically and socially in the United States for deglobalization. We've got Forever Trump Tom right here holding his I Heart Trump sign, and he sees all of the masks that we need or any of the goods that are created over in China or Japan and says, hell no, not anymore. We're going to produce everything right here in the good old USA. That may be great for Tom, but what happens is fewer dollars are going out of the system for Japanese Corp because they're selling fewer goods to the United States. That means less and less cash flow coming into the entities outside of the United States. So if there's less cash flow, why on earth would the banks lend to these corporations? They're looking at that and saying, no, why on earth would we do that? That's not a productive loan. There's no way we're going to make our money back. We're just going to go bust. So even though the swap lines are here, they could be $1 trillion, they could be $10 trillion. It doesn't necessarily mean they'll get to the entities with the dollar-denominated debt. The Fed isn't in control of that totally. There is a transfer mechanism that is outside of their control completely. One way to look at this is just as a normal consumer. Editor, let's flip to the other side. This is our real example. And just in case you didn't figure that out, I wrote it right up on the board for you. You're right here and you're not very happy, making about $4,000 a month, but you have massive amounts of debt. In fact, your debt payments per month are $3,500. It only leaves you $500 left over for food, gas. You're really, really tight on the budget. So let's say you have an emergency. The hot water heater breaks or your car breaks down. It's a $1,000 expense. Where are you going to get it? You can't take it from the $500. That's your food and gas money. You've got to take it from the $3,500 payment you would have made. So let's say another bank comes in and says, okay, well, don't worry about that. We'll lend you another $10,000. So now you can make that full $3,500 payment plus take care of the $1,000 additional expense you had. The problem is now you have an additional $500 a month payment. So before you had $500 a month left over for groceries, for gas, now you have zero. This is why they say liquidity doesn't necessarily solve a solvency problem. Just because you have a couple extra bucks in your pocket this month doesn't mean that next month or the month after you're not in an even worse position. The only thing that solves this structural issue is if your cash flow or your income actually goes up. And you may be saying to yourself, yeah, George, I get it, but wouldn't the central bank, the Bank of Japan, just come in and bail out the corporation? But remember, back in step number 1, when we read from the Fed's website, they said the central bank that took out the swap line initially was on the hook for the dollars. So if the corporation doesn't make their payments because they're this zombie corporation or because of cerveza sickness, for whatever reason, there isn't enough economic output and activity between the corporation and the United States for them to get the dollars they need, they're never going to be able to service the additional loan they're getting from the swap line. Remember, they're increasing their dollar-denominated debt, just like you increased your debt in this example behind me. It's the exact same thing. So the BOJ looks at the corporation. They're in the same boat as the Japanese bank. They're saying, absolutely not. We're not going to lend to you because we're not going to get the dollars back and we don't want to be on the hook. We're not going to hold the bag. So if the banks won't lend to the entities that need the dollars and the central banks won't lend to the entities that need the dollars, what happens to the swap lines? Well, all those dollars just stay inside of the United States. Well, and this is obviously the United States. You can see Florida right here if you didn't know what that was. But those bank reserves and the swap lines stay at the Fed inside of the United States, basically under the Fed bed, and never get out into the system. They could print up 4 trillion, 400 trillion, a quadrillion in swap lines, and it doesn't matter. It still won't work because there isn't the amount of dollar cash flow needed to service not only the existing debt, but the additional debt. I want to circle back and really focus on the value of the dollar compared to XYZ currency, or in this case, the yen. This is really how you're going to understand how the dollar could lose its reserve currency status. In step number 1, we talked about how the supply of dollars can decrease by debt being paid off. But we didn't talk about the supply side of the equation. Let's use a simple example. We have this much debt in the system, but there's always going to be fewer currency units than we have total debt. Why? Because when you create the debt, you have the principal, which creates the currency. In addition to the principal, though, you have interest. So over time, if you use this currency to pay off the principal, you're still going to have additional debt left over. So think about the demand for the dollars or the demand for the currency to pay back the debt you'd have right here compared to right here when there were no currency units left. As you get closer and closer and closer to having no currency units left, the demand for those currency units would continually increase. Let's go back to the corporations for just a moment and think through what happens if they don't have the income or the dollar-denominated cash flow they need to not only pay their debts, but maybe even the additional debts they take on. Well, these corporations are publicly traded. Therefore, they have shareholders that have shares denominated in the local currency or in yen. So if the shareholders see the business going straight into the toilet, the balance sheet's getting worse, the P&L is getting worse, they sell the shares that are denominated in yen, but they most likely still need dollars. Either they see them as a safe haven asset, or they just need the dollars to do business because the entire global economy works on dollars. So basically what they're doing is they're selling the yen and buying dollars. What does that do? That increases the amount of demand for dollars and it decreases the amount of demand for the yen, which makes the dollar appreciate in value against the yen. So in this case, the dollar demand is increasing, it's appreciating. This case, it's appreciating again. And then you say, well, George, what about the central banks? Can't they just print enough yen to go into the FX market, buy the dollars that the corporations need, and then just bail them out? Just like the Federal Reserve would do for all of our corporations on the S&P. Well, that's not going to work because think about what they're doing. They're creating additional yen to buy dollars. So it goes right back to the exact same equation. More demand for dollars, which makes the dollar appreciate. Now let's go over some counter arguments for the dollar going up. And I'm sure many of you are familiar with them if you follow this heated debate with the dollar, whether it's Lynn Alden and Brent Johnson or Luke Groman, Jeff Snyder, Chris McIntosh, whomever. These awesome pros that we all love to listen to are definitely opinionated on which direction the dollar is going. You always hear, well, if the dollar goes up too much and the corporations can't handle the dollar-denominated debt, they'll just go ahead and default. And going back to our example in step number 1, we can kind of see how if we defaulted, it really wouldn't affect the supply of money short term because we just eliminate this loan, this loan, this loan, and this loan. I'm sure I'm duplicating some of the loans there that I'm eliminating. But you see what happens is the loans just get eliminated, but the deposits still stay the same. It's very different than actually paying off debt, where the deposits would actually decrease along with the loans. But the problem with this argument goes back to what we were talking about earlier. If these corporations are getting close to default, the shareholders are going to sell those shares or assets as fast as they can. Basically, what they're doing is selling the yen to buy dollars. So this, it really depends on the situation, but it isn't guaranteed that it would create less demand for dollars. What about selling dollar-denominated asset? One of these corporations could have some treasuries on their balance sheet, as an example. But this argument gets very, very nuanced. Let me try to explain. So Japanese Corp has treasuries on their balance sheet. If they sell these treasuries to someone outside of the United States, and we'll just assume this guy isn't American. He doesn't look that American. Either that or he's a member of Antifa, but Antifa wouldn't have any money. So we'll say he's Arab or something like that. So J Corp sells their treasuries. The dollars go from this gentleman down to J Corp. They pay off their dollar-denominated debt. So the dollars were already outside of the United States. And if J Corp used these dollars to pay off a bank, well, now what they're doing is they're decreasing the amount of deposits in the system, or they're decreasing the amount of dollars. But if J Corp would have sold to Forever Trump Tom that had the dollars inside of the United States, then they're pulling additional dollars outside the US into the international system. And then to make matters even more complex, if they finally got more dollars outside of the system, again, the treasuries go to Tom, the dollars come outside of the United States to J Corp. If J Corp pays back the US debt from a financial institution, it decreases the amount of dollars outside of the United States. So it's basically a wash. But if they pay the debt back to a non-bank, so let's say they borrowed the money from another corporation, then there would be additional dollars coming out of the system that weren't there before, even though they paid off debt. Why? Again, let's review this one more time just to make sure everyone is on the same page. Because if a corporation or any entity is paying off debt to a financial institution that created funny money out of thin air in the first place, when they pay off the debt, the amount of money supply decreases. But if there's existing money supply that's actually loaned out by a non-bank entity, let's say you just get a loan from one of your buddies that takes a $100 bill out of his pocket, gives it to you, you give it back to him, and there's still $100 of money supply that exists. So just to reiterate, there's a big, big difference of whether or not the money was originally borrowed and therefore paid back to a bank or a non-bank entity. And then the final argument is always, well, the Fed is just printing so much money. Holy cow. They're doing these repo operations and bailouts, and the government's spending money in QE infinity. Right, but remember, that goes back to our original problem. The Fed can create limitless amounts of money. The government can spend limitless amounts of money into the economy, which could create massive amounts of inflation in the United States, meaning the dollar is going down in value relative to domestic goods and services. But those dollars aren't necessarily getting outside of the United States to increase the supply of dollars relative to the other currencies. So the takeaway for step number 2 is the swap lines most likely will not work long term. And outside of the United States, there's a lot of tailwind for the dollar relative to other currencies, even though we could be experiencing a lot of inflation, consumer price inflation, inside the United States. Step number 3, the end game. This is how the dollar could actually lose reserve currency status. And unfortunately, this video has gone on way too long, guys. So we're gonna have to make this a 2-part video, but I promise I'll be right back here tomorrow to go over step number 3 and give you the conclusion you deserve, so you can put all the pieces of the puzzle together and connect the dots. If it's already past Friday, you'll see a link for the video right here. And to build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.